Dr. Babasaheb Ambedkar Open University.
Friends, we had discussed about 2 transactions, and in this part we will see 5 more transactions. The more practice you make, the more transactions you study, more knowledgeable you would be. The next transaction is Dinesh Singh brought his personal machinery of rupees 10,000, furniture of rupees 15,000 and personal liability to Mr. Suresh Jain of rupees 5,000 into business. I had told to you in last part that the capital can be brought by the owner, who could be proprietor, partner, etc., either in cash or in kind. So here Mr. Dinesh Singh, who is a proprietor of Dinesh Corporation, he is bringing his personal machinery, personal furniture and personal liability which he owes to Suresh Jain into business. Now, because he brings machinery into business, we have recorded this transaction on 13th November 2014. We are taking one date after the 12th that we had seen in the last transaction. Machinery comes into business. We are recording these transactions in the books of Dinesh Corporation. So from the viewpoint of Dinesh Corporation, machinery comes, furniture comes. Therefore, these are 2 assets. Machinery and furniture are assets. Asset plus asset increases. Therefore, that account will be credited. So we are debiting machinery account. We are debiting furniture account by 10,000 and 15,000 rupees, because we have received machinery of rupees 10,000 and furniture of rupees 15,000. This is by asset plus method, you may call it. Or if you go by the rules of debit and credit for real account, the machinery and furniture are accounts of assets. Accounts of assets are real accounts. For real account, what is the rule? Debit what comes in. Machinery comes in, furniture comes in, therefore machinery account or furniture account debited. And for real account, the rule we had seen is credit what goes out, but machinery does not go out, so machinery account is not to be debited. Suresh Jain's account is credited. Why? Because it is a liability. It was a personal liability of Mr. Dinesh Jain, but now he is bringing this liability into the books of business. Therefore, the amount which is payable to Suresh Jain will now be payable by Dinesh Corporation, the proprietary firm. Therefore, it is a liability. Liability of Dinesh Corporation increases, because now this money of amount of 5,000 payable to Suresh Jain will be payable by Dinesh Corporation. Therefore, liability increases. Therefore, Suresh Jain's account is credited. And the net amount of capital which is being brought in by Mr. Dinesh Singh is rupees 20,000. Why? He has brought assets of rupees 25,000 and he has brought liability of rupees 5,000. So the net assets that he has brought into business is total assets brought minus total liabilities brought, that is 10,000 plus 15,000 is equal to 25,000 minus 5,000 is equal to 20,000 rupees. This amount is credited to his capital account, because when he brings these net assets into business, his capital increases or owner's equity increases. Owner's equity plus means it will be credited. Therefore, capital account is credited. I told to you, instead of writing just capital account, you can also title such account as Dinesh Singh's capital account. Let's look at some other transaction. The next transaction is, you started business, you brought cash into business, you brought some assets like machinery, furniture, etc., and now you start doing business. You purchase goods, you sell goods, etc. So the next transaction we are studying is that of purchase of goods. Such purchase of goods, when we usually say goods, it means the goods in which you are dealing in. When we say purchased goods, it means we are purchasing the items in which we are going to deal in, which we are going to purchase and sell. So, purchase goods of rupees 5,000 for cash. The transaction of purchase could be either cash transaction or credit transaction. When you purchase goods on payment of cash, it is called cash purchase. You may also buy goods on credit. where you buy goods today and you pay them later. It is called credit purchase. In credit purchase, you become a person liable to pay that amount later on. So the person from whom you are purchasing goods will be your creditor. That transaction we will see in the next part. But before that, let's look at what is the accounting treatment or the journal entry for the purchase of goods of rupees 5,000. I have shown you the journal entry, which is purchase account debit rupees 5,000 to cash account credit 5,000. The explanation of this would be why purchase account is debited. Purchase account is an account of goods. Debit what comes in. Goods is real account. So we are debiting purchase account. Cash account is credited. Why? Because cash goes out. When you purchase goods of rupees 5,000 for cash, you pay cash. Therefore, your cash, which is an asset, decreases. So even going by asset plus debit, asset minus credit, the asset, namely cash, is reduced, is decreased by 5,000. Therefore, cash account is credited. We look at the next transaction now. We've already seen cash purchase transaction. Now we are looking at credit purchase transaction. In this transaction, we have purchased goods of rupees 25,000 on credit from Messrs. Rajesh Traders. Whenever credit transaction is there, you would usually be given the name of the party from whom the goods are purchased, and therefore that Rajesh Traders is supplier of goods. He becomes your creditor. You will owe money. You will have to pay this money to Rajesh Traders later on. Today you are getting goods. When goods are coming in, it is an asset account. Asset plus goods increase. Asset increases. Therefore, we are debiting goods account, which we will, any purchase of goods, we will write it as purchase account. So purchase account is debited by 25,000 rupees, and we are not paying cash. We are buying these goods on credit. So the money is now owed to, is payable to Rajesh Traders, and therefore we are crediting Rajesh Traders account by 25,000 rupees, my dear friends. And we are writing narration at the end of each journal entry, being entry for purchase of goods on credit. This is the narration. Narration is details. So merely because you debited and credited accounts, if you write narration, that is an added advantage for the reader of the journal, who will come to know about the details of the transaction, that these goods, this is an entry for goods purchased by you on credit from Rajesh Traders. Let's look at next transaction. On 17th November 2014, Dinesh Corporation is selling sold goods. When we say merely sold goods, who is selling? Dinesh Corporation. Whose books of accounts are you preparing? Whose journal are you preparing? Please remember, we are preparing journal of Dinesh Corporation, a proprietary firm whose proprietor or the owner is Mr. Dinesh, isn't it? So, sold goods for rupees 15,000. It is a sale of goods of 15,000 for which payment is received by check, which is deposited in Dena Bank's account. My dear friends, there may not be such great details in the narration or the transaction that may be given to you. Even if they tell you that the payment is received by check, you should understand that the check that you are going to get, you are going to deposit it in your Dena Bank account, because we have seen in the earlier transaction that you have opened an account with Dena Bank. So whenever the transactions take place through banking channel, it will be routed through your bank account. If you have got more than one bank accounts, then there is a need for giving specific information that this check is deposited into Dena Bank or so and so bank. But here we have got an information with us that we have got only one account, namely Dena Bank, in respect of Dinesh Corporation. So why Dena Bank account is debited? Because we have deposited this check of 15,000, the payment that we have received for sale of goods, into Dena Bank. Therefore, Dena Bank account debit. I have written Dena account debit, but you should write full Dena Bank account debit 15,000 rupees. To sales account credit 15,000. Whenever there is a sale of goods, the goods go out of business. Therefore, when goods go out, credit what goes out. This is a real account, goods account. Or even if you look at from the asset plus or liability plus etc. rule, we had seen owner's equity When it is plus, we are crediting that account. Owner's equity, when it is minus is reduced, we are debiting that account. Whenever transactions of revenue nature take place, revenue nature means revenue expense or revenue income. Sales is a revenue income. When there is a revenue income, capital increases. When there is revenue expense, capital or owner's equity decreases. When owner's equity decreases, what do? You need to remember that rule. When owner's equity increases, what are we doing? When owner's equity increases, we are crediting that account. So in this transaction, when you sell goods, it is a revenue income. So owner's equity increases. Therefore, account will be credited. Which account are we going to credit? We are going to credit sales account. So Dena bank account debit 15,000 to sales account credit 15,000 is the journal entry that you need to learn. The next journal entry here is sold goods of rupees 20,000 to Anil Brothers on credit. The earlier transaction was for cash sales. Now we are selling goods on credit. When we are selling goods on credit, we give goods to our customers, but we get payment later on. So the customer who buys goods, he becomes our debtor. DEBTOR, debtor. It is also known as receivable. So we have to receive 20,000 rupees from Anil Brothers. So Anil Brothers is our debtor. Or we say that we have got receivables of rupees 20,000 from Anil Brothers because we have sold goods of rupees 20,000 to Anil Brothers on credit. So the journal entry is when we sell goods of 20,000 to Anil Brothers on credit, Anil Brothers account is debited by 20,000. Why? It is a personal account. Anil Brothers is a personal account. The rule of personal account is debit the receiver, credit the giver. Here Anil Brothers is receiver of goods. Therefore Anil Brothers account is debited. And any time when you sell goods, we are crediting sales account. Any time when we purchase goods in our business, we are debiting purchase account. This you can by practice. You need not go through the rules. Once you are accustomed to recording this transaction, you will realize that sales means sales account is credited. So this is an explanation of transaction relating to credit sales. With this, we conclude discussion on this part, and we'll see some more transactions in the next part. Thank you very much, my dear friends.
Dr. Baba Sahib Ambedkar Open University.